I hope you're sitting down, Kelly, because I actually agree with Senator Warren, which may be a first for me.
Wow.
She's absolutely right that the Fed can't do anything to bring down inflation, but they can cause a recession. The reason we have this inflation is because we had massive increase in the money supply, massive deficit spending, which the Fed monetized. They can't fix that. The good news is that the money supply has stopped going up. The deficit spending is basically stopped. And so we are on a path to controlling inflation. But all that Fed can do now is throw us into a recession, and that's not going to be helpful.
So you think they should just do nothing at this meeting?
No, I mean, we can't. We right now have such negative real rates. In this inflation environment, having this interest rate environment doesn't actually make a lot of sense. So he needs to increase rates. Rates were artificially low across the yield curve. And so they do need to be higher. But I really do wish he'd stop talking about this being an excessively heated economy causing inflation. That is not what we have now.
Very interesting. So much I want to circle back to and unpack there. Let's do it with Subhadra and Francis. Francis, I think you have a very similar point of view here. You're worried about the economy slowing. Do you think that the conversation should be and will turn to rate cuts?
Absolutely, the conversation will turn to rate cuts because the economy is going to slow materially. But is that enough for the Fed? So the big question for me today is, what is the Fed's decision-making function going to look like over the next 6 to 12 months? We know right now they're very focused on the inflation story. Should they be? Well, they own some of the story, but I agree with my colleagues here. So does fiscal, so does supply chains. They can't cure all with rate hikes. But as we head into the next 6 to 12 months, we are going to see those initial jobless claims rise. We are going to see unemployment get higher. Will they switch back towards focusing on their dual mandate? I suspect later this year we'll see it. I don't think today we're going to see that pivot, though.
I do think, Subhadra, that Bill Ackman makes a really interesting point where the market jumps too quickly to sort of use the playbook from the last recession slowdown where this Fed is going to quickly be shifting to cutting rates. And it's not clear that inflation is actually going to let them do it. I mean, we talked about this yesterday, but there are plenty of people who are skeptical that inflation will be low enough that it would even make sense to start talking about rate cuts. What do you think?
Yeah, no, I think I agree with Bill Ackman's comment. In some respects, I think the market is getting a little ahead of itself. To me, what the concern is that if they do actually overshoot and go to maybe 4% or 4.5% in the Fed funds rate, then there's a heightened risk of a hard landing or a sharp slowdown in the economy that would warrant them to actually cut rates soon after they sort of overshoot quite dramatically. So a better policy prescription, in my view, would be if they sort of get the Fed funds rate to 3 or 3.25%, and then take a much more measured, data-dependent approach. And we could get to that 3 or 3.25% by the end of the year. So after that, I think a much more measured approach to rate hikes makes sense. So this argument of like sort of overshooting first and then having to cut rates aggressively afterwards doesn't make a lot of sense to me.
Do you think there's a chance, Charlie, they'll go just half a point?
No, I think one of the things they have learned is that you don't want to really surprise the market either direction. And I think they've been telegraphing 3/4 of a point, which I think is the right thing to do. Again, our interest rates were abnormally low and they need to be higher, and they're going to get there gradually. That's the right approach. If he does something silly today, he'll lose confidence, and I don't think he wants to do that. You
would call it silly if he goes less than 3/4 of a point?
Yeah, I mean, that would be him saying inflation is not as bad as everybody with their own eyes can see it is. And so that would just be a signal that they've won the war, which they clearly haven't. So we need to stay on the path of modestly higher rates until we get inflation relief. And by the way, we're going to start getting better inflation numbers. Month over month, the numbers are going to start looking better. The year over year numbers are still going to be very high, but the inputs are already have stopped rising as fast as they were before.
There are still places, Francis, where we're seeing upward pressure, core services prices and things like that are way less visible, but nonetheless will be there into 2023 and maybe beyond. So what's your own projection for inflation at this point? We were above 9% last month, or call it 6-7% on PCE. Where do you think we'll be in 12 months' time?
Well, we have us coming back down to 2%, but that's not really the story. The story is what the composition of that inflation looks like. Look, the Fed can bring down many elements of inflation in this economy, even if they were caused by fiscal or supply chain. But they're going to have a heck of a time bringing down food and energy inflation, and shelter is going to come down with a lag. So I suspect we're going to see very bifurcated inflation as we go into next year. And this is why last meeting with Powell was so important, where he said he was looking at energy prices and headline inflation. If they want to change their tune, they can start talking more about core inflation being important. That I would view as a dovish pivot. But look at the composition of inflation and how the Fed speaks about it. I think that's way more important than the headline number.